we'd like to off of the internet. So the common misconception now is people are truly under the belief that they can go out and spend a few $1,000s on a piece of software, load it into their computer, and then 30 minutes later, once that software is receiving live data, that they can simply sit back and click their mouse and all this profit is going to start coming in. But it's interesting because if you do your homework and you look at these popular programs that are advertised heavily via infomercial on the television, when you look at the testimonials of the individuals that have made substantial sums of money in the marketplace, it clearly states in bold print, this is a unique, exceptional opportunity that occurs. But the problem is technology appeals to our sense of immediate gratification. We want to believe that we can have this instantaneous profit in a relatively short period of time because technology can work so well in other aspects of our lives. Only to come to find out that once again we cannot consistently make profit with this technology because it trades under very specific conditions. The other side of the coin is rule-based trading applications or trading methodologies. One of the benefits of a trading methodology is the trading rules can transcend all time frames. In other words, here at the Trading Institute, and what we're looking at tonight is we're looking at 10-minute candlesticks. Each one of these candlesticks represents 10-minute price activity for one 10-minute time frame. Now we use a candlestick chart specifically because it's easy on our eyes. It's easy for us to identify the strategies that we teach here at the Trading Institute. It's easy for us to discern and identify the trading setups. We do not use any Japanese candlestick patterning in our trading methodology. We specifically use a candlestick chart because it's easy for us to interpret the price action that we see. So we trade on a 10-minute time frame because it represents the prime time frame to effectively be able to find trading opportunities in a relatively short period of time. If we were, for instance, to trade on a 5-minute candlestick, there'd be too much whipsaw or price noise for us to be able to identify good trading setups. If we move to a 15-minute candlestick, all of a sudden we're going to be spending more time in front of our computers. So that's why we look at a 10-minute time frame. The other side of the coin is the smaller the time frame, the smaller the risk, so too the smaller the profit potential, but the more frequent the trading opportunity. And there are a number of ways that we can grow our profit trading on smaller time frames. The reality is most people find out they're better suited trading on smaller time frames. Because would you rather make, say for instance, $1,000 in profit in under an hour or do it in 8 hours? Well, obviously the first scenario makes more sense. And so that's the common scenario. What happens is people believe that they can, by spending countless hours in front of their computers and in the marketplace, they're actually going to be able to create more profit, and that's one of the reasons they're inconsistent, is because of the things that I mentioned at the beginning. It creates overtrading, and it creates making poor trading decisions because we have a tendency to read into the markets. The reality is our accuracy and our ability to make better trading decisions is when our focus is at its key, and that happens only when we spend minimal amount of time in front of our computer. So the benefit of a trading methodology is one, it transcends all time frames. In other words, we could trade on a larger time frame. Our strategies, it would just mean they would happen less frequently, require more capital, and so on and so forth. The other benefit is it transcends all market conditions. We can use our trading strategies with our rule-based trading application in both these consistent sideways conditions as well as when market's in a trending environment. There's a great rule of thumb that says you can always make money using sideways-based trading strategies in any market condition, but you can't make money using trending strategies in sideways conditions. And that's why people are so inconsistent in their profit taking, is because they are constantly looking for these using these trend-based trading tools in these consistent sideways conditions. Another benefit of learning a rule-based trading application is it will transcend all markets. We can trade in other marketplaces. It's just that we focus on the FOREX because it offers us the most consistent opportunities, because it's the largest market in the world, it's the most volatile market in the world, it's the fastest moving market in the world, so it affords us the most frequent opportunities for trading on an online venue, and it's the most efficient marketplace in the world. So that's why we focus on trading the FOREX. So common pitfall number one and key reason why people are typically not consistent is they gravitate to technology first. The key reason why people are consistent And the key correlation to why they're able to become consistent is those individuals go out and get a clear-cut understanding of how to interpret price in the marketplace. They get a foundation and training and a training in the whys and hows of what makes price move in the marketplace. The reality is a price chart a chart is simply a roadmap of price. And once you get a clear-cut understanding of how to navigate that roadmap, you're then on your way to becoming successful as a trader. The reality is price is truly the only predictive indicator we have. All other indicators are lagging. Stochastics, MACDs, whatever type of moving average you would like to select, whatever momentum indicator you would like to select, they are all lagging in information. Price is truly the only leading and predictive indicator that we have. In fact, I like to call price the ultimate trading indicator. The reality is all trading distills down to is the relationship against price and time. And that's why indicators also perform best on large time frames. The reality is indicators not only perform best on large time frames, but indicators perform best keeping you in a position, but don't necessarily help you find a good entry point into the marketplace. And the reason is because there's too many false signals, or what we call whipsaw. The other reality is if you really do your homework on indicators, what you're going to find is the majority of popular indicators that are out there were developed and designed to trade in markets that trade in an 8-hour trading day. They're typically evaluating some type of high, low, and close. The other thing is they're typically designed to trade in markets where we wanted price to move in one direction, and that was typically north for an extended period of time. In other words, they typically were developed and designed to trade, for instance, on the equities market, where when we enter into a position, we want that position to go up for the rest of our lives. And so moving averages and some of these other tools help us understand when conditions are overbought or oversold and tell us when to stay on the sidelines and help us stay in a position. But in markets that trade in a 24-hour environment like the FOREX, in markets that trade both in up and down directions within a 24-hour period, there are so many false signals, especially trading on a small time frame, it's difficult to use indicator-based trading programs trading in this marketplace. And that's why the individuals that are consistent and successful get a clear-cut understanding of how to interpret price in the marketplace. In fact, I encourage you to once again, thoroughly review our website after today's presentation and take a look at our testimonials. What you'll find is a lot of traders who used to trade with heavily laden indicator programs no longer use any indicators at all and find their trading decisions are far easier and much more accurate because they have less information to interpret. They also trade with a greater sense of certainty because they're no longer reliant solely on the indicators. They trade with confidence because they have the ability to evaluate the market conditions that are in front of them and interpret the price activity that they're seeing and then make good trading decisions based on that. So once again, the key reason why people are typically successful is those individuals get a clear-cut understanding of the whys and hows of what makes price move in the marketplace. The reality is learning how to trade is no different than learning any other discipline. We potentially now have markets turn back around on us a little bit here. We potentially have a short opportunity developing over here on our dollar versus yen. It's starting to wake up a little bit, so we'll keep an eye out on that here as we move forward here. So as I was saying is the reality is that learning how to trade is just like learning any other discipline. I'm always amazed at individuals when they pursue all other disciplines in their life, professional disciplines, athletic disciplines, pursuing playing a musical instrument, taking on an artistic endeavor of some fashion. They all understand that good training and practice and repetition and getting an understanding and the foundation, the basics of a particular discipline is the key to growing your success and your acumen. And then it requires practice and it requires a repetitive process to become better and stronger at your skill set. But for some reason, when people pursue and focus on trading, they throw that belief out the window. For some reason, they believe there's a silver bullet out there that they can purchase that's going to immediately make them a consistent and professional trader because they've bought this tool that's going to create this shortcut for them, and then they can disregard having to learn how to understand price. when in fact learning how to trade, once again, is just like learning any other discipline.